All right, let's talk about turning those big financial dreams you have, the ones that seem kind of far off, into an actual concrete plan. Today, we're diving into a really powerful strategy to do just that.
So let's say you've done all the responsible stuff. You've got your emergency fund set up, your insurance is in place, you're basically secure. Great. But that just leads to the big question. What do you do now?
And that's the thing, right? Having that financial security, that's not the finish line. That's the starting line. It's the launch pad that lets you start building something really amazing for your future.
Think about it. Right now, your savings might just be sitting there, kind of waiting around. But that money could be your hardest working employee, clocking in 24/7. It's time to go beyond just saving for emergencies and start investing for the life you actually want to live. Let's put that money to work.
So how do we do that? Well, there's this really smart framework for it, and it's called goal-based investing. And it's a total mindset shift. We're moving from just vaguely investing to investing with a very clear, very specific purpose in mind.
Okay, so what does that actually mean? Stripped down, it's a strategy where every single dollar you invest has a specific mission. It's all about creating a clear, efficient path to get you exactly where you want to go financially.
I absolutely love this analogy because it just clicks. Your goals are like destinations on a map. You wouldn't hop on a little city scooter to go on a massive cross-country road trip, would you? Of course not. And it's the exact same idea with your money.
And that brings us to the really practical part of all this. Actually categorizing your goals so you can choose the right financial vehicle for each and every milestone you're aiming for.
So here's how we break it down. We've basically got two big buckets. On one side, you have your short-term goals. These are the things you want to achieve in the next 1 to 5 years, like saving for a wedding, a big vacation, or a down payment on a house. Then, on the other side, you've got the long-term stuff, goals that are 5+ years away, like your retirement or your kids' college education. The timeline, as you'll see, changes everything. Now, for those short-term goals, the game plan is totally different. The number one priority isn't to hit a home run. It's to protect the money you've already saved. That's why we look at safer options like debt funds or even fixed deposits. The key words here are capital preservation, keeping your money safe, and liquidity, which just means you can get your hands on the cash easily when the time comes.
But when we flip over to long-term goals, the whole mindset shifts. Now we're talking 5, 10, even 20 years down the road. Here, the name of the game is wealth creation. You can afford to take on a bit more risk for the chance at much higher growth. This is where things like equity mutual funds really shine, along with tax-saving tools like PPF or ELSS, which are all designed to harness the power of compounding over time.
All right, theory is great, but what does this actually look like for a real person? Let's make this concrete and walk through a quick example.
So let's meet Rahul. He's 26, he's a software engineer, and he's at that point where he's ready to get serious and make a plan for his future.
Rahul has a big short-term goal on the horizon. He wants to build a marriage fund of 15 lakhs, and he needs it in 3 years. Super specific, right? That's the key.
So how's he going to do it? He sets up a monthly SIP, a systematic investment plan, for 35,000 rupees. But here's the most important part. Look where that money is going. Debt and hybrid funds. He's perfectly matching the investment vehicle to his short-term timeline. He's not gambling with his wedding money. Smart.
Okay, so just like any road trip, you need some rules to make sure you actually get to your destination. There are a few key things to keep in mind to stay on track and, avoid hitting any potholes along the way.
Think of these as your non-negotiables. You've got to check in on your portfolio regularly because, hey, life happens. This next one is huge. You always have to factor in inflation. And that last point is critical. As your goal gets closer, you de-risk. You move money from those growth-focused investments into safer ones to lock in your gains.
And on the flip side, here are the traps you want to avoid. The absolute biggest one is using a one-size-fits-all approach. Your retirement fund and your vacation fund are two totally different animals. And when the market takes a dip, it's so tempting to panic and sell. For your long-term goals, that is often the worst thing you can do. You have to ride out the waves.
So we've covered the what, the why, the do's and the don'ts. The only thing left is, how do you actually get started? Well, the good news is your journey can literally start right now. And here it is, your 6-step action plan. It's really not complicated. Just list out your goals, sort them into those short-term and long-term buckets, figure out what you need to save, and then pick the right tools for each job. Then you automate it, set it and forget it, and just check in every quarter. That's the entire playbook. You know, when you boil it all down, this is what it comes to. The real magic here isn't some secret formula. It's about starting as early as you can, being incredibly consistent with it month after month, and just having the discipline to stick with your plan.
Look, every single one of your dreams, whether it's a trip around the world or a comfortable retirement, it has a price tag. That's just a fact. But now you have a roadmap to actually pay for them. So the only question left is, what's the very first goal you're going to start planning for?